All right, guys, welcome to the SRS segment this week. We got a special guest, Wayne Carr. How we doing, bro?
I'm doing well. How are you, Mike?
I'm doing awesome, dude. I'm like a little kid with the fake applause, but it gets me in the mood. It gets me excited. It makes me think people are excited. Now they are watching, so
Yeah.
so I guess that technically it could be like real applause. It's just,
I mean, buttons are buttons.
That's absolutely, dude. Well, hey, thanks for joining us. And I'm excited to talk about this topic because to be fully transparent, I don't really know much about Infinite Bank. I don't. When I sold, we didn't have that. I mean, our simple retirement solutions were just annuities, IULs. We didn't do any of this back then. I hear, everywhere I look, Wayne, every call I'm on, I hear just people talking about this concept. So I know you do a lot of it, so that's why we got you on today. And our goal today, guys, is really to just, I guess, demystify, simplify this, and that's kind of been our thing each week. It's, these are not advanced products. They're just retirement products. They're not advanced. Mm-hmm. They're just different. It's no different than when I started. I started selling life insurance in 2009. The only type of leads we had were mortgage protection, and then we had really, really bad internet leads. Like horrible ones. Like people went on and clicked for they went to fill out a Home Depot credit card and all of a sudden they're getting, more life insurance. Like so they were garbage. They were nothing like the ones you guys have now. And then they introduced final expense leads. We started getting those 2010, 11. And I feel like the same way some of our guys look at these products as advanced. Back in the day, we had handfuls of agents, Wayne, that looked at final expenses that I can't do that. It's too complicated. The clients are too old. They think it's free. They don't want me to come out to their house. They don't trust me. Right. And then but the truth is, Wayne, it's a mindset thing, right? So y'all know Sean. Sean is like, dude, he doesn't say can't. He doesn't say try, right? It was like, dude, we'll figure it out. It's going to be different. We'll figure it out. Like, be an adult. Just call them up, tell them to come in the house. And when you're out there, find out what they need and help them out with life insurance. It's not that deep. And we did. We sold more final expense than anyone at that company. But it was a mindset that we had that they didn't. They looked at it as advanced, complicated. We didn't. So that's kind of like what we're trying to do with this, or not what we are doing with this simple retirement solutions is we don't want you to look at infinite banking, IULs, annuities as advanced. We just want you to look at it as something different. There may be some additional education you need to do, some additional training, but anyone that's selling a life insurance policy, mortgage protection, final expense, you could also sell these products. You just have to do a little work, right? So without any further ado, Wayne, we'll hop right into it, dude. So if you can, real quick, if you want to just break down just overall, what is the overall concept of infinite banking? Lay that out, and I'm sure I'll have some follow-up questions.
Sure. No, and thanks for having me. It's an honor. It's been a while, and I, like a kid in a candy store, I was just excited and elated, over the moon, and honored to be here, especially with something like this, because just like you said, it is the wave, but it's not that we didn't have it when you were selling insurance. It's just that we weren't exposed to it.
Yeah.
Because truth be told, infinite banking has been around since prior to the Great Depression, because the people that actually survived the Great Depression survived it because they had this to lean on, because they were using this to build for retirement, and they were able to borrow from themselves. So the concept of infinite banking is really just eliminating the bank and becoming your own bank. And it's much more rewarding because it's dual faceted. Like, you hear the antiquated approaches of not having your investments and your insurance in the same place. But we do it with everything else. I mean, we have TVs with everything built into them, cars with everything built into them. So it makes more sense than not to have, especially in this case, your insurance and your investment partially tied together. I'm not saying put everything here, because there's a smart money investment order and all types of things. You can get into the weeds pretty quick, but it's really, in its purest form, a means of accumulating cash value at an accelerated, consistent rate, and having access to that cash basically on demand. So a lot of people tend to look to IULs and things like this for cash accumulation, but the IUL is a baby. So when we talk about the Great Depression and we talk about infinite banking and high cash value insurance, that alone tells you that there's something else that was there that people used before this. And if you look at the presentations, because there's a lot of misinformation out there. You see things like reference like Ray Kroc and McDonald's and how they expanded, and J.C. Penney and even Walt Disney, how he funded Disneyland, Disney World when nobody else would from his life insurance policy. And it was just an infinite banking policy where you can dump an excess amount of cash in there, a lump sum, or you can overfund it on a monthly basis consistently throughout the year. But you have more bandwidth to dump more capital or more cash into the policy to accelerate the accumulation, and you have better liquidity. I can give you, whereas in the other vehicle that a lot of people are positioning, you don't have any liquidity for the first couple of years. I can give you 80, 90% liquidity in year one to borrow from yourself and go do something else with the money. Real estate, other investments, cut into your interest rate to help pay your mortgage off early, to help eliminate credit card debt. So there's a number of uses for it, but in its purest form, it's a bank within your insurance policy.
Got it. So it is an insurance policy.
100%.
There's a death benefit.
From day one.
Day one death benefit. And so is it a lump sum you need to move into this? Is it just a monthly payment? So talk to me about the process of setting one up. How does that work?
Sure. So typically what I look for is someone that has a lump sum sitting in a savings account that doesn't need it. Doctors that have excess income coming in, or anybody that has excess income, and especially entrepreneurs. Because when I reference a smart money investment order, it's free money if you don't have a 401k match. If you have a 401k match, you want to take advantage of that. If you don't, the next is tax-free money, which is life insurance. This is the only way to essentially grow money tax-free. And then after that, it's tax-deferred, which is your IRAs, Roths, and things like that, and then your taxable income. So if you have a lump sum or you just have excess capital and can contribute a couple $1,000s a month to the policy and have it add up over the course of the year, in infinite banking, the other tell is you earn dividends. Like in a true infinite banking policy, it's compound dividends and not compound interest, which is more consistent. And when we talk about the consistency of the growth, dividends, when the company hasn't missed a dividend payment in over 100 years, compared to tying something to an index where it might miss a couple times throughout your lifetime and it completely derails the illustration that you sold it based on. This is more consistent, more guaranteed. And when you're planning for retirement and trying to plot out things, these are planners. So this just makes more sense. And I mean, imagine your workout. You have your workout, you go into the gym. If you get into the gym and you start skipping things, the effectiveness of your workout is depleted. And it's the same here.
Right.
So there's a number of ways to structure it. We can start it with the dollar amount that you want to contribute, or we can start with the face amount and figure out how much insurance you actually want and how much you're capable of overfunding. Or we can just build it based on the lump sum. So it really depends on the individual, but it's not a cookie cutter or one size fits all. It's fully customizable.
Got it. Let's talk about, and I hear you, there's all different, options, different ways to set it up. But I guess the average policy or what you see most of, is it someone with a lump sum? If so, what is that number typically where you say, hey, this would be a good fit for infinite banking? And then from there, what is a typical monthly premium for an average size policy that you're writing?
Sure. So the monthly premium fluctuates, but typically if there's a lump sum being dumped into it, the monthly premium is somewhere between 8 and 10, 8 and 10 division of that lump sum,
okay,
the annual premium. So if it's $100,000, the annual premium is going to be somewhere between $8,000 and $10,000.
Got it.
Because there's still MEC, there's still guidelines for it to stay classified as an insurance product and not as a true investment vehicle, which allows it to grow tax-free and not accrue capital gains taxes. So we have to keep it within that framework. But again, if we're coming from the other side and you have your income or a flat dollar amount that you want to contribute, then that that dictates the amount that you can overfund it to, because
Got it.
you can literally, I mean, there's a book called What Would the Rockefellers Do? Everybody knows who the Rockefellers are. So you could just imagine how those policies are structured. And when we start talking about $1 million babies, which a lot of people talk about in reference to that other vehicle, this, you can plot out that that's truly $1 million baby. It's like having a baby and saying this baby's going to go to the NBA. Well, not if this, and this happens, but if I put them over here and say this baby is going to go to the NBA, and I look at the guarantees here versus the guarantees here, I have a better chance of seeing what that looks like here versus over here.
Got it. So let's kind of play out like a real use case. Let's say I'm your client, right? I'm 30. Well, we'll add a few years. Say I'm 40 years old. I don't have a lump sum to dump in this, but I get, $5-6 grand a month. Is this a product for me, or are you not even looking at, like, would it be something where I'd say, hey, I'd put my whole income in this, and what could I do with the product, or is this not for me?
Well, I wouldn't tie up your whole income, but I would use a portion of your discretionary income. I would figure out what your monthly expenses are, how much of that is tied to an interest rate, and add that in with your discretionary income and run that through the policy. Because it's essentially like being in two places at once. Imagine if you could be at the gym right now, even if you're doing a 50% more effective workout than you would normally do if you were just present at the gym. If you were doing this recording with me right now and at the gym, you'll be exponentially more productive throughout the day.
Yeah, we got to figure that out.
Just double dipping, making your dollar that much more productive throughout your lifetime, which is why it helps you get out of debt early, pay your mortgage off early, prepare for retirement like you wouldn't be able to otherwise. And then for business owners too, when you start talking about your monthly revenue versus your monthly expenses, and you run that money through an insurance policy, now you don't have the weight of the world on your shoulders of building an empire for the next generation, because you have whatever you do build plus this inordinate death benefit that's amassed because of the money that you're able to contribute to the insurance policy. It's a whole life policy, so it's guaranteed to be there for the rest of your life, as long as you maintain the premiums. The overfunding is just icing on the cake in excess.
Got it. All right. So you're not going to take their whole income, but let's use business owners. Say I got 10 grand coming in a month through my business, right? Walk me through, what is that like? How much of that would you suggest to put in here? And then what would that do for the client hypothetically?
So if you have 10K coming in a month, we'll say your monthly expenses are 5K.
Okay.
So your monthly expenses fluctuate. So you had 10K coming in. I'm going to put the 5K in the policy and leave the 5K liquid so you can manage your expenses with ease and with peace of mind. But that other 5K is going to go into that policy every month, which is 60 grand a year. So you're going to earn compound dividends on that 60 grand a year, regardless of whether that money stays in the policy or not. Now, there's going to be months where maybe your expenses are a little over 5K, where you may need to borrow from yourself, but you're borrowing from yourself and creating your own repayment schedule. And even though you borrow from yourself, you're still earning compound dividends on that entire 60K as if it never left the policy.
Got it. Okay. So I can borrow from myself at any time.
At any time. It's just like you log into your online banking now. You set up the ACH and it's in your account in 2 or 3 days.
Got it. But you're saying my dividend credit. So say I'm doing this 5K. Say I'm only 3 months into it. I put 15K in this. But my dividend, and then I go, oh man, I need to take, $5 grand out. Could I do it at that time?
Yep.
And then my dividend is still based off of the 60K, even though I took out 5 grand.
Exactly.
Got it.
That 60 turns into 120, 180. So your dividend is essentially growing. And at some point, pretty early on in the policy, you have a cash on cash return where you can't get that anywhere else. Where you're basically getting back what you put into the policy, and the policy is self-sufficient in paying for itself. And then everything else that you do is truly just putting yourself and your family in a better position financially. Yeah,
absolutely. And then we already talked about it. There's a lump sum similar to, if you're setting up an IUL, well, it's very similar to these other products, right? Like if you're setting up an IUL and say we're writing this way and I go, dude, I got 20 grand in this account I don't use. I want to 1035, whatever, move it into this product. We can do that. But you're saying we can do the same thing with this infinite banking. Is that something that only happens at the beginning? Say I have this policy and I come into some money, business starts doing well, and I go, yeah, I'd love to add some more. Is there the ability? Is there any flex with that?
Well, we can do a couple of things. We can layer the policies because, as you know, there's no limit to the amount of insurance policies you can have.
Yeah.
Or we can structure it to withstand your growth within a certain amount of time. Because of MEC, what happens in the first 7 years dictates what you can do throughout the life of the policy. So we can structure it to withstand that down the line, but it's probably best to structure it to maximize it now,
Yeah.
and then just layer them as the business grows.
Got it.
So it's funny that you say like these other products, like because this is the original.
Yeah.
This is the one that all these other products are trying to compete with or trying to mirror.
Got it.
This is the original, and a lot of times, as you know, again, not to be a dead horse, but the gym analogy, all these other workouts and things come out, but there's some things that are tried and true in your workout that you won't substitute because of the effectiveness and the efficiency.
Yeah, absolutely.
And this is no different.
Yeah, no, that makes perfect sense. Now I get, so you write a ton of these, Wayne. What are the majority of them that you setting up? Do they normally have a lump sum they're dumping in the beginning? Are they more the way we were talking with the income base? Like what, I guess, give me kind of the average policy that you write. And I know they're all over, but if you say, hey, 5 out of the 10 I write are usually this, what would that be?
Most of them are income based. Most of them are people that don't have a plan for retirement, and we're maximizing their income to help them plan for retirement tax free.
Got it.
And reallocating funds to there, because going back to becoming your own banker, what we're trying to do is eliminate the bank. And if you think of a credit card machine at the gas station, you want to use your bank for your transactions and use your insurance policy to actually hold your money, because it's not doing you any good. The terminal does you no good. The bank really does you no good. You're literally helping the bank grow.
Right.
And if you look at a bank's balance sheet, they literally have billions of dollars in life insurance while they're loaning your money back out to you. It's not a coincidence. So if you have an opportunity to do exactly what the largest financial institutions in the country do, like, why wouldn't you participate in that vehicle directly?
Yeah, absolutely. Is there a minimum and is there a maximum? Minimum of what you can start with, a maximum of what you can put in?
There's really, and that's why it's such a beautiful product, because it works literally on every level. Obviously, it's more effective the more money you have. Hence the book, What Would the Rockefellers Do, and what they've been able to do generation after generation. But for somebody that's trying to put the next generation in a better position, I mean, it has to start somewhere. So, I mean, if you have to go to the gym and start with the bar because you're not strong enough, then start with the bar and work your way up. You're going to get stronger as time goes on. So generation after generation, that starting point is going to change dramatically. And there's a few books like that I think everybody should start with. One is Nelson Nash's Becoming Your Own Banker. And then there's Money, Wealth, Life Insurance. I think his name is Jake Keenan, that talks about high cash value life insurance and how to utilize it. And I think those two together give you everything that you need to have a solid foundation and the confidence to talk to anybody about this.
Got it. What's the underwriting like? Is it simplified? Is it fully underwritten, non-med?
It's typically fully underwritten.
Yeah.
Depending on the insurable interest of the company, they will go through more of a simplified mirrored process.
Yeah.
Where they don't necessarily require blood and urine. They'll just issue it standard.
Got it.
For the most part, they're going to go blood, urine, and because it's a whole life policy and there's risk involved for them too.
Got it. And this is, guys, this is not like, we're not leading with this, right? This is still, and we will have to reiterate this every week, that our bread and butter is simplified issue, mortgage protection, final expense. These simple retirement solutions are on top of that. It's not in lieu of. We don't go out and go, oh, you don't need the life insurance? How about this? Like it's because I remember, when I was a new agent mentor many years ago, Wayne, when we started talking about annuities, and all of a sudden some of my guys would come back to me and like, how'd you do today? Oh, I didn't close anything, Mike, but I got 4 go backs for annuities. Like, oh God. Okay. Like the life insurance first, bro, please. So be clear. But now, I bring that up. But my last question, Wayne, is, so how are you finding these clients? What questions are you asking? And then what are what are some signals where you go, ooh, that's going to be a good client for infinite banking versus the annuity, the IUL, whatever? Like, so how are you uncovering these, and what are some signals to where you know this would be a good fit?
Some of the things that I look for is income. Obviously, if we're going through a proper financial inventory, you see typically what their mortgage is, what their liabilities are, and then what their income is. So you can pretty well gauge how much of that income that they're actually dependent upon on a month-to-month basis. So if there's an excess of three, five, 10, $15,000, then it probably better serve them in an insurance policy, which they're looking for anyway, where they can earn compound dividends that they likely haven't heard about. And people like that are always looking for ways to better deploy their resources and operate more efficiently.
Yeah.
So you have those people with, again, the discretionary income, entrepreneurs who don't have a retirement plan provided by their employer, because going back to the smart money investment order, if free money is not available, tax-free money is the next best thing.
Yeah.
And an insurance policy is the only way to put it, or the only way to go about that. And then anybody that has a lump sum, if you're asking that question, do you have anything else that acts like retirement? Savings accounts, 401ks, large balances in your checking accounts, anything else that your family would lean on, and they tell you that they have those things, a savings account, things like that, or they're maxing out their 401k because they say I have a 401k, and you ask about it, then those are all people where you want to put the excess here because there's no maximum like there is in a Roth. So you can literally structure it to take as much money as possible. And if they have a lump sum sitting in a savings account, they know that it's not making any money for them there. And if they don't, then tell them that it's making less than probably 0.01% or less than 0.5%. If I can show you a way to protect your family and grow this at 50, 100 times of what it's growing at now, and you still have access to those funds, would that make sense to you financially?
Got it. That makes perfect sense, dude. And you know,
Yeah.
I love that you broke that down, because it's not for everyone. It's for certain types of clients. And that's kind of like the idea behind this training, is learn which clients an IUL makes sense for, an annuity, infinite banking, or maybe it's just the life insurance. Maybe it's just the, well, I shouldn't say that because they're all life insurance. Maybe it's just the mortgage protection. Maybe it's just the final expense, but we're not saying, hey, go out there and offer this to all your clients. No, there's a certain percentage, but the key is asking these questions, finding the information. And then if you've never written one, dude, that's what SRS is for. Like, we don't expect you to listen to this one training by Wayne and I'm going to go out, I'm going to read those books Wayne said, I'm going to sell all this infinite banking. No, like, let's get someone who's done it for a while. That's what we do through SRS, and have one of these individuals help you out. They'll run illustrations, they'll walk you through it. But it's just the goal behind this is really to get you all to understand the differences and how simple they are. And then just start asking the questions. Get out. No different than when you first started running life insurance appointments. Your first appointment, you didn't know what to do. I didn't. But dude, I learned a lot after one failed appointment. I learned more from that one failed appointment than I learned from hours of training. I'm glad I did the training, but then I went back to the training afterwards, and then I was actually able to understand what they were talking about. Before I ran the appointment, I didn't even know how to listen to on the training. I'm just like, that sounds good. I'll try that. Same thing with this. Like, start asking the questions, start uncovering the money, talk to SRS, get an illustration, try it out. You'll learn a lot more from your first one, and someone will help you. They'll even get on the phone and talk to your client. Like, there's all these options where you have this assistance to do it. So why not take advantage of it? It's just one more way, to help clients. Now, I guess the important part is, for a lot of people, we get paid on this. How does that work, right? Obviously, we're straight up compliant, but what are the percentages like? You don't have to tell me yours, but like what are the percentage, and are you paid on the annual premium? Are you paid on what they're putting in? Like, how does that structured on this type of product?
Yeah, on the Simple Retirement Solutions comp grid, Lafayette is there, so you just find your comp level, and then it'll tell you what the commission is. Yeah, and you're paid on the annual premium, and you get a percentage of the lump sum or the overfunding throughout the policy.
So similar to an IUL, where you get paid on the annual, and then there's some additional based off of if there's a lump sum put into it.
Exactly.
Got it.
Yep. 100%.
And is the comp, like, let's say I'm at 100% comp, Wayne, would you know what the Lafayette is? Is it higher, lower, about the same?
It's probably going to be between 70 and 80.
Okay.
If you're at 100. So typically it's 20 to 30 point spread. I could pull it up.
No, that's fine. So 20, 30 points lower than your FFL comp. But obviously when you're writing these products, these aren't the $1,000 annual premium. We're talking, I mean, even the little example we gave, we're talking 60 grand a year. Like it, you know, so it's a big deal. It's a lot, you know, and it's great for the client. You know, I mean, I think everything we do is right. That's why I feel so good about what we do, is because we sell things that help. I even hate to use the word sell, but we help.
We're providing solutions.
Right.
Especially in this case, a solution to a problem that a lot of times they don't know that they had, because they don't realize how much they're missing and how much money that they're throwing away.
Absolutely.
And like you said, if you don't know, the SRS team has been amazing to me throughout my career here, and they continue to surpass my expectations. So if nothing else, like you said, if you think it's a candidate, find out, bring it to them.
Yeah.
If it's not a candidate, at least you know what not to look for, what
absolutely
not to waste your time on going forward.
Yep.
And they'll be there throughout that process.
Yep. Only way to learn, man, is by doing. And before I had my coughing fit, what I was going to say was we just, to your point, we just put them in a better position. Every product we have, everything we do is about putting that client in a better position than where they were when we found them, right? They have no mortgage protection. They have a mortgage. They have a family. We want to protect the mortgage. They're a little bit older and they fill out a final expense lead. They have nothing for their bet. We want to make sure that when they pass, that's not something their family's worrying about. And then these retirement solutions, we want to make sure that the clients don't outlive their money. We want to make sure that they live comfortably in retirement. And we have 3 very strong products, different, a lot of similarities, but very different use cases that all put your client in a much better, position. So, but I appreciate you doing this, Wayne. This is great.
No, I appreciate the opportunity.
Absolutely, dude. And guys, if there's any follow-up questions on this, like always, hey, email us, drop them in the comments. We'll make sure that we get back to them if there's anything. I know this is just kind of introduction to this, and we'll continue these conversations week in and week out. And if there's anything that you guys want us to train on that you're unsure of, don't feel comfortable with, please let us know, because this is about you. Like, I can get on and talk to Wayne every day, but the training's about you guys. So let us know what you're looking for, what you need, but we appreciate you guys getting on.